Legal disclaimer. The content presented in this video and throughout this series is strictly for educational and entertainment purposes only. It does not constitute financial, investment, tax, or legal advice. Trading foreign exchange Forex on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Any historical data, case studies, or performance statistics are provided for illustrative purposes only and do not imply or predict future results. Past performance is not indicative of future outcomes. You assume full responsibility for your trading decisions and results. There is a brutal statistic floating around the institutional trading floors of New York and London, one that brokers rarely whisper to new clients but is essential for your survival. It is called the 90-90-90 rule. It states that 90% of new retail traders will lose 90% of their capital within their first 90 days of trading. That is not a warning. That is a statistical probability derived from decades of market data. If you open a brokerage account today and start clicking buttons based on a gut feeling, or because you saw a line cross another line on a chart without understanding the underlying mechanics, you are not investing. You are providing liquidity to the institutional sharks who actually run this game. You are essentially donating your savings to a hedge fund manager's year-end bonus. But here is the question that should keep you up at night. What exactly are the other 10% doing differently? How does a small minority of retail traders manage to navigate the most volatile, liquid, and aggressive financial market on the planet and actually survive to extract profit? The answer is not that they have a magic crystal ball. It is not that they have insider information, and it is certainly not that they are smarter than you. The difference between the 90% who wash out and the 10% who stay in the game comes down to a single, non-negotiable concept: structure. The winners treat trading as a business with strict operating procedures, while the losers treat it as a casino. This video series is your transition from the casino floor to the business office. We are going to strip away the noise, the hype, and the marketing gimmicks to hand you the blueprints for 3 distinct, logic-based methodologies that professional traders use to engage with the market. We are not just going to tell you what they are. We are going to deconstruct the psychology, the risk profiles, and the mechanical execution of each so you can identify which one aligns with your personality and your life constraints. To understand why you need a strategy, you first have to respect the arena you are stepping into. The Forex market is not like the stock market. The New York Stock Exchange trades roughly $20 to $30 billion in volume per day. That sounds like a lot until you look at Forex. The foreign exchange market processes approximately $6.6 trillion every single day. To put that into perspective, the Forex market trades the entire monthly volume of the New York Stock Exchange in a single afternoon. It is the largest, most liquid market in human history. This volume is driven by Centra, banks managing national currency reserves, multinational corporations hedging against exchange rate risk to protect their payrolls, and massive hedge funds moving billions of dollars in speculative flows. When you sit down at your computer with a $500 or $1,000 account, you are a minnow swimming in an ocean of leviathans. The market does not care about your tuition payments, your rent, or your desire for financial freedom. It is a ruthless, efficient mechanism designed to find equilibrium between buyers and sellers. In this environment, chaos is the default state. Prices spike due to geopolitical news, economic data releases like the non-farm payrolls, or interest rate decisions by the Federal Reserve. If you enter this chaos without a rigid framework, your emotional brain, the amygdala, will take over. You will buy because you see a green candle and feel fear of missing out or FOMO. You will sell because the market dips and you feel panic. You will hold on to losing trades hoping they turn around, and you will cut winning trades early because you are terrified of losing a small profit. This emotional roller coaster is the precise reason the 90-90-90 rule exists. A trading strategy is your shield against this chaos. It is a set of predefined rules that dictates exactly when you enter the market, exactly when you exit, and most importantly, exactly how much you are willing to risk. It removes the decision-making process from the heat of the moment. When you have a strategy, you are no longer guessing, you are executing a business plan. You are operating based on probability, not possibility. A A professional trader does not know if the next trade will be a winner or a loser. In fact, they do not care. They care about whether they followed their rules, because they know that if they follow a strategy with a positive expectancy, a mathematical edge, then over a series of 100 trades, the law of large numbers will work in their favor and they will end up profitable. In this comprehensive masterclass, we are going to explore 3 specific ways to navigate this landscape. We are going to look at scalping, day trading, and swing trading. These are not just buzzwords. They represent 3 completely different relationships with time. Time is the hidden variable in trading that most beginners ignore. The scalper tries to steal small slices of movement from the market in seconds or minutes, acting like a high-frequency operator who demands intense focus and rapid execution. The day trader treats the market like a standard 9-to-5 job, looking to capture the daily expansion of price and going home flat, with zero exposure overnight. The swing trader adopts a more strategic, longer-term view, holding positions for days or weeks to capture major macroeconomic shifts, requiring patience and a completely different psychological tolerance for risk. Most beginners fail because they try to trade a strategy that contradicts their personality. If you are an impatient person who needs instant gratification, you will self-sabotage if you try to be a swing trader. If you are a thoughtful, analytical person who likes to take their time, you will be destroyed emotionally if you try to scalp. This series is designed to help you identify your trader profile. We are going to break down the setup, trigger, and management for each of these styles. We will look at the charts, identifying the technical patterns that historically precede price movements. But we will go deeper than patterns. We will discuss the why. Why does a strategy work? It works because human psychology is repetitive. Market participants react to fear and greed in predictable ways today just as they did 100 years ago. A chart pattern is simply a visual representation of mass human psychology. When we see a double top or a head and shoulders, we are seeing a visual footprint of buyers losing conviction and sellers taking control. However, understanding the strategy is only half the battle. The other half, and frankly the more difficult half, is risk management. You can have the best strategy in the world, one that wins 80% of the time, and still go bankrupt if you do not understand position sizing. Conversely, you can have a strategy that only wins 40% of the time and make a fortune if your winners are 3 times larger than your losers. This is the mathematical reality of trading that we will drill into you. We are moving you away from the mindset of, how much money can I make on this trade? To the professional mindset of, how much capital am I exposing to risk on this trade? Before we dive into the first strategy, you need to understand that there is no holy grail. If you are looking for a system that never loses, stop watching now. Such a thing does not exist. Even the best hedge funds in the world, staffed by PhD mathematicians and utilizing supercomputers, take losses. Losses are not failures. They are the cost of doing business. They are the overhead expenses of a trading operation, just like inventory costs for a retail store or raw materials for a factory. The goal is not to avoid losses, but to keep them small, manageable, and contained within the parameters of your strategy. As we proceed to part 2, prepare yourself to take notes. We are going to dissect the high-octane world of scalping. We will examine the specific indicators used, the time frames required, and the intense discipline needed to pull profit out of the market on a minute-by-minute basis. We will look at how professional scalpers utilize the concept of flow and momentum to ride the coattails of institutional orders. But remember, everything we discuss is built on the foundation of risk management and psychological discipline. Without those, strategy is useless. Welcome to the deep dive. Let's begin with the fastest, most aggressive form of trading. Strategy number 1 is scalping. If trading were a sport, swing trading would be test cricket or baseball, long, strategic, and requiring endurance. Day trading would be a standard football match. Scalping, however, is bare-knuckle boxing in a phone booth. It is fast, it is aggressive, and it requires reflexes that border on instinctual. When you decide to become a scalper, you are making a conscious decision to ignore the macroeconomic picture. You do not care about the GDP of the Eurozone next year. You do not care about the interest rate projections for 2026. You care about one thing and one thing only. What is the price going to do in the next 60 seconds? Imagine for a moment you are sitting at your desk. It is 8 a.m. Eastern Standard Time. The New York market is about to open, overlapping with the London afternoon session. This is the golden hours of liquidity, where trillions of dollars are changing hands. A scalper does not look for a 100-pip move. They are looking to snatch 5 pips, maybe 10 pips out of the market, and then disappear before the market even realizes they were there. A pip, or percentage in point, is the standard unit of measurement in Forex. For the euro to US dollar pair, a single pip is the fourth decimal place. Sounds microscopic, and it is, but the scalper uses leverage, borrowed capital from the broker, to magnify that microscopic movement into a significant percentage gain on their account. Let's break down the mechanics of a classic scalp setup to demystify how this actually works in practice. Picture a 1-minute chart. Most people look at monthly or daily charts to see trends. The scalper lives on the 1-minute and 5-minute time frames. On your screen you have two exponential moving averages, the 9-period EMA and the 20-period EMA. These lines smooth out the chaotic price action to show you the immediate momentum. The theory used by thousands of retail scalpers is relatively simple. When the fast line, the 9 EMA, crosses above the slow line, the 20 EMA, with conviction, it signals a burst of short-term buying pressure. But here is where the novice fails and the professional survives. The novice sees the cross and immediately hits buy. The professional waits. They know that in the high-frequency world of scalping, fakeouts are common. Institutional algorithms often push price up to grab liquidity before slamming it back down. So the professional waits for a pullback. They want to see the price shoot up, and then gently come back down to touch the 20 EMA, treating it as a trampoline. That touch, that precise moment where the price respects the average and starts to bounce, is the trigger. Let's walk through a theoretical trade data point. You see the bounce on the euro to US dollar at 1.1250. You enter a buy order. Your target is not the moon. It is simply 1.1255, a 5-pip gain. Your stop loss, the safety net that closes the trade if you are wrong, is at 1.1247, a 3-pip risk. This gives you a risk-to-reward ratio of nearly 1 to 2. If you hit your target, you make decent profit. If you hit your stop, you lose a small amount. The trade lasts 4 minutes. It hits the target. You exit. You have made your money. Now imagine doing that 10, 20, or 30 times a day. That is the life of a scalper. It is a volume game. It is about compounding small wins over and over again until they stack up into a substantial income. However, we must address the silent killer of scalping strategies, something that ruins more accounts than bad analysis: the spread. The spread is the difference between the buy price and the sell price. It is the commission the broker takes for matching your order. In the world of swing trading, where you are aiming for 100 pips, a 1-pip spread is negligible. It is a rounding error. But in scalping, it is everything. Consider the math carefully. If your strategy aims for 5 pips of profit, and your broker charges a 2-pip spread, the market actually has to move 7 pips in your direction just for you to realize your 5 pips. That is a 40% tax on your movement required just to hit your target. Conversely, if the market moves just 1 pip against you, you are already down 3 pips including the spread. The odds are mathematically stacked against the scalper from the moment they click the mouse. This is why professional scalpers are obsessed with ECN brokers, electronic communication networks, that offer raw spreads as low as 0.0 or 0.1 pips. If you try to scalp on a standard retail account with high spreads, you are essentially trying to run a marathon with a backpack full of bricks. The friction of the transaction costs will eat your edge alive. Furthermore, scalping requires a psychological state that is often described as the zone. You cannot hesitate. In a swing trade, you can make a cup of coffee while you think about your entry. In scalping, if you hesitate for 3 seconds, the opportunity is gone. The risk-to-reward ratio has shifted, and the trade is no longer valid. This induces a high level of decision fatigue. Historical data on trader performance suggests that decision quality degrades significantly after prolonged periods of intense focus. A scalper might be brilliant from 8 a.m. to 10 a.m., making pristine, disciplined trades. But by 11 a.m., the brain is tired. The dopamine receptors are fried. This is when the revenge trade happens. Imagine a scenario where a scalper takes 3 losses in a row. It happens. It is statistically probable. They are down 3% of their account in 15 minutes. The amateur scalper feels a surge of anger. They feel the market owes them that money back. So, on the next trade, they double their position size. They ignore the 9 EMA and 20 EMA setup. They just feel the market is going up. They buy. The market drops. They lose huge. This is the tilt. In poker, it means playing irrationally after a loss. In trading, it means blowing up your account. Scalping is the most fertile breeding ground for tilt because the feedback loop is so fast. You find out if you are a winner or a loser every few minutes. That constant judgment weighs heavily on the human ego. Case studies of successful scalpers show they often trade for only 1 or 2 hours a day. They treat it like a surgical procedure. They scrub in, they operate during peak volatility, and they leave. They do not sit in front of the charts for 8 hours because they know that trying to scalp during low-volume times, like the lull between the US close and the Asian Open, is suicide. The market becomes choppy, the spreads widen, and the technical patterns break down into noise. So, is scalping for you? If you have a high tolerance for stress, the ability to make split-second decisions without regret, and the discipline to stop trading when you hit your daily goal or your daily loss limit, then perhaps. It offers the quickest feedback and the potential to grow a small account rapidly because of the frequency of opportunities. But it also carries the highest risk of ruin due to emotional burnout and transaction costs. But what if you have a job? What if you cannot be glued to your screen at 8 a.m. because you are commuting, or in a meeting, or taking your kids to school? What if the idea of making 50 decisions an hour sounds like a nightmare rather than a dream? Does that mean you can't trade? Absolutely not. In fact, the majority of profitable retail traders find scalping too intense and sustainable only for short periods of their lives. They need a strategy that balances lifestyle with profitability. They need a strategy that treats the market not as a video game, but as a structured business day. This brings us to the second, and perhaps most widely respected methodology in the professional world: day trading. Unlike the frenetic energy of the scalper, the day trader operates with a different philosophy. They aren't trying to steal crumbs. They are looking for the meat of the move. But how do they find it without staring at the screen all day? And what is the one golden rule that separates a day trader from a gambler? The answer lies in a specific routine that starts before the market even opens. Day trading begins not with a chart, but with a calendar. Before a professional day trader even looks at the price of the British pound or the Japanese yen, they are checking the economic schedule. They are looking for red folder events, central bank announcements, inflation data releases, or unemployment numbers. Why? Because these events act as massive disruptors. If you are in a trade and the US Federal Reserve unexpectedly hikes interest rates, the market can move 100 pips against you in a single second. This is called slippage. It means your stop loss might not even trigger at the price you set. It will trigger at the next available price, which could be way below your safety net. So the first step of the day trader's routine is defensive, identifying the times not to trade. Once the minefield is mapped out, the day trader zooms out. While the scalper was obsessed with the 1-minute chart, the day trader starts on the daily time frame to establish a bias. If the daily candle for the last 3 days has been green, showing strong bullish momentum, the day trader has a simple rule: do not sell. They will only look for opportunities to buy. They are looking to swim with the current, not against it. This is what we call top-down analysis. You start with the big picture to understand the river's direction, and then you zoom into the 15-minute or 1-hour chart to find a safe place to jump in. The specific strategy we are going to dissect here is known as the breakout and retest. It is timeless, it is logical, and it appears on every asset class from Forex to crypto to stocks. Here is the psychology behind it. Imagine the market is a battle between buyers and sellers. For 4 hours, the price of the euro to US dollar bounces between 1.1000 and 1.1050. It hits the ceiling resistance and falls. It hits the floor support and rises. This is consolidation. The market is deciding its next move. Inside this box, the day trader does absolutely nothing. They sit on their hands. This is the hardest part of trading, doing nothing when you want to make money. Then a breakout happens. A massive green candle smashes through the 1.1050 ceiling. The price surges to 1.1060, then 1.1070. Now, here is the imaginative scenario where amateurs get slaughtered. The amateur sees the explosion. They see the price running away without them. They feel that panic in their chest, FOMO. They think, I have to get in now or I miss the profit. So, they buy at the very top at 1.1070. This is the trap. Almost invariably, after a violent breakout, the market needs to breathe. The buyers who got in early start taking profits. The momentum fades. The price starts to drop. It falls from 1.1070 back down to 1.1060, and then it approaches the original breakout level of 1.1050. The amateur who bought at the top is now in the red, sweating and praying. They panic and sell for a loss. But the professional day trader? They have been waiting for this exact moment. They were waiting for the price to return to the scene of the crime. This is the retest. The theory of polarity states that what was once a ceiling resistance will now become a floor support. When the price touches 1.1050 again and refuses to go lower, perhaps printing a bullish pin bar or a hammer candle, that is the confirmation. That is the entry signal. The day trader buys at 1.1050. Their stop loss is tight, just below the new floor, maybe at 1.1040. Their target is the next major resistance level, perhaps at 1.1100. By waiting for the retest, they have secured a superior entry price and a clearer invalidation point. If the price falls back into the box, they know the breakout was fake and they get out with a small bruise. But if the trend resumes, they catch the next wave up, often riding the momentum created by fresh institutional orders defending that new support level. Now let's talk about the golden rule that makes day trading distinct from every other style: flat by close. A true day trader never, under any circumstances, holds a position overnight. When the New York session winds down at 5 p.m. Eastern Standard Time, they close everything. Win, lose, or draw, the account is all cash. There are two critical reasons for this. First, the swap. In Forex, if you hold a trade past the daily rollover time, you either pay or receive interest based on the difference between the two currencies' interest rates. Often, this is a fee that eats into your profits. Second, and more importantly, is gap risk. The Forex market runs 24 hours a day during the week, but liquidity dries up significantly between the New York close and the Asian Open. Furthermore, unexpected geopolitical events, wars, natural disasters, or emergency policy shifts often happen when you are asleep. If you are holding a position and a major event occurs, the price might gap. This means the market closes at one price and opens the next millisecond 50 or 100 pips away. If that gap jumps over your stop loss, your broker cannot close your trade at your safety level. They have to close it at the next available price. Imagine you risked 1% on a trade. A massive news event happens overnight. The market gaps. You wake up to find that you didn't lose 1%, you lost 10%. Or worse, you owe the broker money. By going flat by close, the day trader eliminates this catastrophic risk entirely. They sleep soundly knowing their capital is safe in cash, immune to whatever chaos happens in the world while they are dreaming. Day trading offers a compelling balance. It provides the potential for daily income like scalping, but without the frenetic, heart attack-inducing pace. It allows for more thoughtful analysis. You have time to draw your levels, calculate your risk, and wait for the perfect setup. A day trader might only take 1 or 2 trades a day. If the morning session in London doesn't provide a clean breakout and retest, they simply walk away and wait for the New York session. If New York is choppy, they shut down the computer and come back tomorrow. They are snipers lying in wait for the perfect shot, rather than machine gunners spraying bullets at everything that moves. However, there is a limitation to day trading that forces many people to look elsewhere. It still requires you to be present during specific hours. The best moves happen when the London and New York sessions overlap, 8 a.m. to 12 p.m. Eastern Standard Time. If you have a 9-to-5 job, live in an incompatible time zone, or simply cannot commit to being at a screen for 3 to 4 hours straight every single day, day trading becomes logistically impossible. You cannot day trade effectively from your phone while sneaking glances during a meeting. That is gambling. Furthermore, day traders often miss the big move. They capture the daily fluctuation, perhaps 50 pips. But sometimes a currency pair will start a trend that lasts for 3 months and moves 1,000 pips. The day trader captures small chunks of that, but they pay spreads and commissions every single day to get in and out. They leave a massive amount of potential profit on the table because their rules force them to exit at 5 p.m. What if there was a way to capture that entire 1,000 pip move? What if you could analyze the charts on Sunday night, set your orders, and then check your phone once a day for 10 minutes while you go about your life? What if you could profit from the slow, massive shifts in the global economy rather than the daily noise? This requires a complete shift in psychology. You have to be willing to endure drawdown, seeing your profit turn into a loss temporarily, without panicking. You have to have the conviction to hold a trade through news events, earnings reports, and market volatility. This is the realm of the swing trader. It is the style most favored by wealthy investors and those with full-time careers because it decouples your income from your time. But do not be fooled. While it requires less time at the screen, it requires significantly more emotional fortitude. In the next part, we are going to break down the trend-following mechanism of swing trading and expose the specific chart patterns that signal a multi-week run is about to begin. Strategy number 3 is swing trading. If scalping is a sprint and day trading is a middle distance run, swing trading is an expedition. It is the strategy of choice for the farmer. Unlike the scalper who hunts for a kill every few minutes, the farmer plants seeds, positions, and waits for them to grow. They understand that real wealth in the financial markets is rarely generated by frantic activity. It is generated by sitting tight and being right. This approach is fundamentally different because it aligns with the primary forces of macroeconomics. While a 5-minute candle is often just random noise or algorithmic twitching, a weekly candle represents the flow of billions of dollars of trade balance, interest rate adjustments, and geopolitical shifts. To succeed as a swing trader, you must master the art of trend following. The adage "the trend is your friend" is a cliché for a reason, but most beginners misunderstand it. They think a trend is just a line going up. In reality, a healthy trend is a rhythmic breathing mechanism. It moves in waves. This structure is defined by Dow theory, which dictates that an uptrend consists of a series of higher highs and higher lows, while a downtrend consists of lower lows and lower highs. Imagine you are walking up a staircase. You step up, impulse move, then you pause to catch your breath on the landing, correction or pullback, then you step up again. The swing trader does not buy while you are stepping up. That is chasing the price. The swing trader buys when you are resting on the landing. They are looking for value. In an uptrend, value is found during the pullback, specifically when the price retraces to a previous structure level or a key dynamic support zone. Let's scrutinize a specific, high-probability technical pattern that swing traders hunt: the bull flag. This is a continuation pattern that occurs after a strong, vertical move upwards, known as the flagpole. Following this surge, the market enters a period of consolidation where the price drifts slightly downwards in a narrow channel, resembling a flag flapping in the wind. Here is the psychology behind the bull flag. The flagpole represents a surge of institutional buying, hedge funds and central banks accumulating a currency. The flag itself, that downward drift, represents profit-taking. The early buyers are cashing out, causing a slight dip. However, notice that the price does not crash. It drifts. This indicates that despite the profit-taking, there is no heavy selling pressure entering the market. The bears are weak. The bulls are still holding the line. The swing trader watches this flag form with patience. They draw a trend line across the top of the flag. They set an alert. They do not guess. They wait for the market to tip its hand. The trigger occurs when the price breaks aggressively above the top trend line of the flag. This signals that the profit-taking phase is over and the next leg of the trend, the next impulse, is beginning. The swing trader enters on this breakout. Their target is often calculated by measuring the height of the flagpole and projecting it upwards from the breakout point. This is a measured move, a technique derived from historical market geometry that suggests markets often move in symmetrical waves. Let's apply this to a historical case study involving the US dollar to Japanese yen pair. Imagine the Federal Reserve announces it will keep interest rates high, while the Bank of Japan maintains negative interest rates. This fundamental divergence creates a massive uptrend for the dollar against the yen. The pair shoots up 500 pips in a week, the flagpole. Then for 2 weeks it chops sideways and slightly down the flag. The amateur trader gets bored or scared and sells. The swing trader recognizes the pause. When the price breaks out of that consolidation, the swing trader enters a long position. They might hold this trade for 3 weeks, capturing another 600 pips as the fundamental reality of the interest rate difference continues to drive the price higher. However, swing trading introduces a variable that day traders never have to deal with: overnight risk and the psychology of drawdown. When you hold a trade for weeks, you will inevitably see your open profit fluctuate. You might be up $2,000 on Tuesday, but on Wednesday, a minor retracement drops your floating profit to $800. The amateur panics. They think, "I lost $1,200, and they close the trade prematurely. The professional swing trader understands that the market does not move in a straight line. They know that as long as the market structure, the sequence of higher highs and higher lows, remains intact, the trade is valid. They have to develop a mental callus, an immunity to the daily noise. They check the charts once a day, usually at the daily candle close, 5 p.m. New York time, to make decisions. Checking the chart every hour is actually detrimental to a swing trader because it tempts them to micromanage a macro trade using micro information. Another critical component for swing traders is the swap, also known as the rollover. Since you are borrowing one currency to buy another, you are essentially dealing with two interest rates. If you buy a currency with a high interest rate like the US dollar in recent years, against a currency with a low interest rate like the Japanese yen, the broker pays you interest every single day you hold that trade. This is called a positive carry. There are large hedge funds that trade solely to capture this interest, regardless of price movement. However, if you take the opposite side, selling the high-interest currency, you pay interest every day. Over a hold period of 3 months, negative swap can significantly eat into your profits. Therefore, a professional swing trader always checks the swap rates before entering a long-term position. It is an additional fundamental filter that aligns the trade with the flow of global capital. But perhaps the most dangerous trap for the aspiring swing trader is the boredom factor. Swing trading is slow. You might only find 3 or 4 high-quality setups in a month. In the downtime, the brain craves dopamine. This leads to forced trades, where a trader looks at a messy chart and hallucinates a pattern just to have some action. To combat this, many swing traders trade a basket of pairs, perhaps monitoring 10 or 20 different currency crosses, to increase the likelihood of finding a clean setup without lowering their standards. We have now covered the what and the how of scalping, day trading, and swing trading. You should have a clearer idea of which style fits your personality. Are you an adrenaline junkie with quick reflexes? Scalping. Are you a disciplined, routine-oriented individual who likes to sleep flat? Day trading. Are you a strategic thinker with patience and a busy lifestyle? Swing trading. But knowing the strategy is like having a Ferrari without a steering wheel. You can go fast, but you will likely crash. The steering wheel, the brakes, and the airbag of trading is risk management. It is the single most boring topic to talk about, and the single most important factor in your survival. Without strict mathematical risk management, every single strategy we just discussed has a 100% failure rate over a long enough timeline. It is a mathematical certainty. If you risk 10% of your account on every trade, you only need a losing streak of 5 trades to lose nearly half your capital. And once you lose 50% of your money, you need to make 100% profit just to get back to break-even. This is the drawdown trap, and it is where 90% of traders die. In the next part of this masterclass, we are going to leave the charts behind for a moment and open the spreadsheet. We are going to construct the unbreakable risk model. We will define exactly how to calculate your position size so that no matter how many times you lose in a row, you stay in the game. We will discuss the concept of R multiples and how to skew the math so that you can be wrong 60% of the time and still make a living. This is the secret that separates the professional gambling syndicates from the casual punters. Get your calculators ready. Welcome to the mathematics of survival. If you take nothing else from this entire series, let it be this section. You can trade with a coin flip, literally heads for buy, tails for sell, and if your risk management is perfect, you can outperform a trader with a PhD in economics who ignores these rules. The concept we are about to unpack is called asymmetric risk, and it is the only reason professional trading firms exist. Let's start with a hard truth. You are going to lose. You are going to lose often. You are going to lose streaks of trades. You might lose 5, 6, or 7 times in a row. This is not a reflection of your intelligence. It is a statistical inevitability. In a random distribution of outcomes, losing streaks happen. If you do not account for this, the market will bankrupt you during your first month. To protect yourself, you must adopt the 1% rule. This rule is non-negotiable for every single trader managing serious capital. It states that you never, under any circumstances, risk more than 1% of your total account balance on a single trade idea. Let's run a simulation to prove why this is vital. Imagine 2 traders, Trader Alpha and Trader Beta. Both start with $10,000. Both are using a strategy that is currently going through a rough patch. They both hit a losing streak of 5 trades. Trader Alpha is aggressive. He wants to grow his account fast, so he risks 10% per trade. On trade 1, he loses $1,000. He is down to $9,000. On trade 2, he risks 10% of the remaining $9,000, which is $900. He loses. He is down to $8,100. By the end of 5 losses, Trader Alpha has lost nearly 41% of his entire capital. He is left with roughly $5,900. Now here is the kicker. To get back to his original $10,000, he needs to make a return of almost 70% on his remaining money. In the professional world, a 70% return is a miracle year. Trader Alpha is effectively dead in the water. Now look at Trader Beta. She follows the 1% rule. On trade 1, she risks $100. She loses. She has $9,900. On trade 2, she risks $99. She loses. After 5 losses in a row, she is down roughly 4.9%. She still has over $9,500. To get back to break-even, she only needs a return of about 5.2%. She can make that back in 1 or 2 good trades. Trader Alpha is ruined. Trader Beta is just having a bad Tuesday. This is the power of defensive mathematics. But how do you actually execute this? This brings us to position sizing. Most beginners think risk is where they place their stop loss. They think, if I put my stop loss 100 pips away, I am risking more than if I put it 10 pips away. This is false. Risk is a function of your lot size, not your stop loss distance. You must adjust your position size dynamically for every single trade to ensure the dollar amount at risk remains exactly the same. Let's look at the mechanics. You have a $10,000 account. Your risk limit is 1%, which is $100. Scenario: you are scalping. Your stop loss is tight, only 10 pips away. To make those 10 pips equal $100 of risk, you need a value of $10 per pip. You would trade a standard lot 1.0. Scenario B: you are swing trading. Your stop loss is wide to account for volatility, let's say 100 pips away. To make those 100 pips equal the same $100 of risk, you need a value of $1 per pip. You would trade a mini lot 0.1. In both scenarios, if the trade hits your stop loss, you lose exactly $100. The swing trade had a stop loss 10 times wider than the scalp, yet the financial damage to your account is identical. This is the secret to trading volatile markets. You don't fear volatility. You simply reduce your position size to accommodate it. You must use a position size calculator, available for free online, before every single trade entry. If you are guessing your lot size, you are gambling. Now that we have capped our downside, let's talk about the upside. This is where we flip the math in our favor using R multiples. R stands for your risk unit. In our example, 1R equals $100. The goal of a professional trader is not to have a high win rate. You can win 90% of your trades and still go broke if your winners are tiny and your losers are huge. The goal is to have a high risk-to-reward ratio. Let's imagine you aim for a minimum of 1 to 2 risk-to-reward on every trade. This means for every $100 you risk 1R, you aim to make $200 2R. Let's play out a sequence of 10 trades. This is a realistic sample set. Let's say you are a mediocre trader. You lose 6 out of 10 trades. That is a 40% win rate. Most people would think a 40% win rate is a failure. Let's do the math. You lose 6 trades. Since you always risk 1R, you have lost a total of 6R. Minus $600. You win 4 trades. Since you target 2R on your winners, you have gained 8R. Plus $1,600. Your net profit is roughly $1,000, minus commissions and spreads. You were wrong more often than you were right, yet you made a 10% return on your account. Now, imagine if you become slightly better and hit a 50% win rate with a 1 to 3 risk-to-reward ratio. 5 losses equals minus 5R. 5 wins at 3R each equals plus 15R. Net profit equals 10R. You just doubled your account while being wrong half the time. This is the holy grail. It isn't a magic indicator. It is the mathematical expectancy of cutting losses quickly and letting winners run. The amateur holds onto a losing trade, hoping it turns around, turning a 1R loss into a 5R disaster. Then, when they finally get a winning trade, they get scared and close it early for a 0.5R gain. They flip the math against themselves. They feed the machine. To operate this unbreakable risk model, you must detach yourself from the money. You cannot think in terms of rent money or car payments. You must think in terms of R. I made 2.5R this week. I lost 1R today. This abstraction is a psychological shield. It turns the chaos of the market into a scored game. However, there is a dark side to risk management that we must warn you about. The martingale fallacy. This is a dangerous strategy often sold to beginners where you double your position size after every loss to make it all back, plus a profit. The logic is, I can't lose 10 times in a row, right? Wrong. You can. And you will. If you start with a standard lot and double down after a loss, by the time you hit a losing streak of just 10 trades, which happens historically in every strategy, you would need to trade over 500 lots to cover the loss. No retail broker will allow that leverage, and you will have blown your account long before you get there. Martingale is a guaranteed path to zero. Do not touch it. Stick to fixed fractional risk, the 1% rule. So we have our 3 strategies: scalping, day trading, and swing trading. We have our safety net, the unbreakable risk model. Now we need the tools to make the decisions. We need to know how to read the dashboard of the car. You have likely seen charts covered in colorful lines, histograms, and oscillators. Traders argue endlessly about which ones are best. Is the RSI better than the stochastic? Is the MACD the king of momentum? Or are they all just lagging indicators that tell you what already happened, offering zero predictive value? In the next part, we are going to perform a forensic audit on the most popular technical indicators in the world. We are going to strip away the mystery and show you exactly how they are calculated, which ones professional bank traders actually look at, and which ones are essentially useless graffiti on your chart. We are going to teach you how to combine them to build a confluence system that filters out the noise and highlights the signal. Prepare to clean up your charts. Open your trading platform right now. If your chart looks like an abstract art painting, covered in a spaghetti bowl of red, blue, and green lines, with 3 different oscillators stacked at the bottom, you are suffering from a condition known as indicator paralysis. This is the most common affliction among retail traders. You are looking for confirmation in so many places that you end up freezing. You buy because the MACD crossed over, but then you sell 2 minutes later because the stochastic is overbought, and then you panic because the Bollinger Bands are squeezing. You are letting the dashboard drive the car. To become a professional, we need to perform surgery on your charts. We are going to strip everything away until we are left with the naked price, and then we are going to add back only the tools that provide unique, non-redundant information. You must understand one fundamental truth before we look at a single tool. Indicators are derivatives of price. They are simply mathematical formulas applied to open, high, low, and close data. They cannot predict the future any more than the speedometer on your car can predict a traffic jam ahead. They only tell you what is happening right now, or what happened 5 minutes ago. Their value lies not in prediction, but in filtering. They help you filter out noise to see the dominant psychological state of the market. We categorize indicators into 3 distinct families: trend, momentum, and volatility. The amateur mistake is stacking 3 indicators from the same family. If you have the RSI, the MACD, and the stochastic on your chart simultaneously, you are essentially asking 3 people who are reading the same script to give you an opinion. They will always agree, giving you a false sense of confidence. A professional confluence system requires indicators from different families to agree before a trade is executed. Let's start with the king of trend, the moving average. Specifically, the 200-period simple moving average, SMA, and the 20-period exponential moving average, EMA. The 200 SMA is not just a line. It is a self-fulfilling prophecy. It is watched by every major bank, hedge fund, and institutional algorithm in the world. It acts as the line in the sand for the long-term trend. If the price is above the 200 SMA, the environment is bullish. If it is below, it is bearish. We do not trade against the 200 SMA, but the real magic happens with the 20 EMA. Unlike the simple moving average, which treats all data points equally, the exponential moving average gives more weight to recent price action. It reacts faster. In a strong trend, price will often pull back to the 20 EMA and bounce off it like a trampoline. This is dynamic support. Instead of drawing horizontal lines across every peak and valley, the 20 EMA provides a rolling floor for the price. A classic strategy involves waiting for the price to pull back to the 20 EMA, while still above the 200 SMA. This aligns your short-term entry with the long-term capital flow. Next, we move to the king of momentum, the Relative Strength Index, or RSI. This is perhaps the most misunderstood tool in finance. Most beginners are taught the 70-30 rule. If the RSI hits 70, the market is overbought, so you should sell. If it hits 30, the market is oversold, so you should buy. This advice is dangerous. In a strong parabolic trend, the RSI can stay above 70 for weeks. If you sold the US dollar to Japanese yen pair every time the RSI hit 70 during its massive rally in 2022, you would have wiped out your account 10 times over. Overbought does not mean the price will drop. It simply means the buying is aggressive. The professional uses the RSI to hunt for divergence. This is the secret weapon of counter-trend traders. Divergence occurs when the price acts one way, but the momentum acts another. Imagine the price makes a higher high, it breaks a resistance level and looks strong. But at the exact same moment, the RSI makes a lower high. This is a crack in the foundation. It tells you that while the price is rising, the engine powering that rise is running out of fuel. The buyers are exhausted. When you see bearish divergence forming at a key resistance level, the probability of a reversal skyrockets. You are no longer guessing. You are seeing the internal weakness of the trend before it collapses on the chart. Finally, we address the king of volatility, the Bollinger Bands. These are plotted as two standard deviations away from a central moving average. Think of them as a rubber band around the price. The market spends 95% of its time inside these bands. When the price punches through the upper band, it is a statistical outlier, it is stretched. But the most powerful signal from Bollinger Bands is the squeeze. Markets cycle between periods of high volatility and low volatility. It is a breathing rhythm. When the bands contract and become very narrow, it means the market is compressing. It is building up potential energy. A squeeze is almost always followed by a violent expansion or explosion of price. The amateur gets bored during the squeeze because nothing is happening. The professional gets ready. They know that the longer the squeeze, the more explosive the breakout will be. They place their entry orders just outside the bands to catch the explosion the moment it happens. Now let's build the confluence system. We do not take a trade because of one indicator. We take a trade because of the stacking of probabilities. Imagine a courtroom scene. You are the judge. The trade is the defendant. You need to convict the trade, execute it. You cannot convict based on one witness. That is circumstantial evidence. You need multiple independent witnesses. Witness 1, structure. The price has returned to a key support level we drew from the daily chart. Witness 2, trend. The price is bouncing off the 20 EMA. Witness 3, momentum. The RSI is showing bullish divergence. Price made a lower low, RSI made a higher low. When you have structure, trend, and momentum all aligning at the same specific price point, you have confluence. You have a great setup. This does not guarantee the trade will win. Remember, nothing is guaranteed, but it significantly tilts the odds in your favor. It allows you to trade with conviction. Instead of taking 10 mediocre trades based on a hunch, you take 2 high confluence trades based on evidence. However, even with the cleanest charts and the best confluence, there is a massive invisible force that can shatter your technical analysis in milliseconds. You can have the perfect double bottom, perfect RSI divergence, and perfect moving average support, but if the chairman of the Federal Reserve walks up to a podium and speaks 3 specific words, your chart patterns will dissolve instantly. Technical analysis is the study of the past to predict the future. But the market is driven by the now. It is driven by data releases, interest rate decisions, wars, and elections. This is the ghost in the machine. Many technical traders try to ignore it, claiming it's all in the price. This is a fallacy that leads to catastrophic losses during news events. To truly master the market, you must understand the engine that drives the price. You need to understand why a currency moves. Why does the US dollar get stronger when the stock market crashes? Why does the Australian dollar rise when China's economy booms? Why does inflation data matter more than anything else? In the next part, we are going to pull back the curtain on fundamental analysis. We are not going to turn you into an economist, you don't need a degree for this. We are going to teach you how to read the economic calendar like a pro. We will explain the risk-on/risk off sentiment that dictates global capital flow, and show you how to avoid getting run over by the news algo spikes that hunt retail stop losses. We are moving from the charts to the real world. Welcome to the engine room. If technical analysis is the study of the map, fundamental analysis is the study of the weather. You can have the most detailed map in the world knowing every twist and turn of the road, but if you drive your sports car into a hurricane, you are going to crash. In the Forex market, the hurricanes are economic data releases. To operate as a professional, you must first understand that money flows to where it is treated best. This is the iron law of capital. If the United States is offering a 5% interest rate on government bonds, and Japan is offering 0%, global investors, managing trillions in pension funds and sovereign wealth, will sell their yen and buy US dollars to earn that yield. This massive flow of capital is what creates the multi-month trends that swing traders ride. It is not a random line on a chart. It is the shifting of tectonic plates based on yield and economic health. Your primary tool for navigating this is the economic calendar. Every Sunday, before you even look at a chart, you open this calendar. You filter out the noise and look only for high-impact events, usually marked in red. These are the events that have the power to invalidate your technical analysis in a split second. Let's dissect the most volatile event in the trading month: the non-farm payrolls, or NFP. This report is released on the first Friday of every month at 8:30 a.m. New York time. It tells us how many jobs the U.S. economy added or lost, excluding the farming industry. Imagine a scenario where the market expects the U.S. to add 150,000 jobs. This is the forecast. The market prices this expectation in days before the release. If the euro to US dollar is trading at 1.0800, that price already includes the assumption of 150,000 jobs. Now the clock strikes 8:30 a.m. The number hits the wires. Scenario A. The actual number is 155,000. It is close to the forecast. The market barely moves. The volatility is contained. Scenario B. The actual number is 300,000. This is a massive beat. It implies the U.S. economy is overheating. When the economy overheats, the Federal Reserve is historically likely to raise interest rates to cool it down. Higher interest rates mean a stronger dollar. Within milliseconds, literally faster than you can blink, algorithms read this data and dump billions of euros to buy dollars. The euro to US dollar crashes 100 pips in 30 seconds. If you were holding a buy position based on a technical double bottom pattern, and you did not check the calendar, you are now destroyed. Your stop loss might have been at 1.0780, but because the price moved so fast, the liquidity vanished. The next available price was 1.0750. You experienced slippage. You lost 3 times more than you planned. This is why we have a strict rule. We do not hold short-term speculative positions through red folder events unless we are already deeply in profit and have reduced our risk. However, data is not just about raw numbers. It is about sentiment. The global market oscillates between 2 distinct psychological states: risk-on and risk-off. Understanding which state we are in is the key to choosing the right currency pairs. Risk-on is the state of optimism. The global economy is growing, trade is flowing, and there is no immediate threat of war or recession. In this environment, investors feel safe. They take their money out of safe, low-yielding assets and pour it into higher-yielding, riskier assets. Capital flows into the stock market, S&P 500, NASDAQ, and into commodity currencies. The commodity currencies are the Australian dollar, AUD, the New Zealand dollar, NZD, and the Canadian dollar, CAD. Why? Because Australia exports iron ore and gold, New Zealand exports dairy, Canada exports oil. When the world economy is booming, factories need iron and oil. Therefore, the demand for these currencies rises. If you see the S&P 500 making new highs, you should be looking for technical setups to buy the Australian dollar to US dollar or Canadian dollar to Japanese yen. You are trading with the wind at your back. Risk-off is the state of fear. This happens when a pandemic hits, a war breaks out, or a major bank collapses. Panic grips the institutional investors. Their priority shifts from return on capital to return of capital. They sell everything: stocks, crypto, commodity currencies, and they flee to the safe havens. The primary safe havens are the US dollar, USD, the Japanese yen, JPY, and the Swiss franc, CHF. The US dollar is king because it is the world reserve currency. In a crisis, everyone wants cash. The Japanese yen and Swiss franc are historical safe havens due to their nation's massive creditor status and political neutrality. Imagine a geopolitical crisis erupts in the Middle East overnight. Oil prices spike. Fear spreads. Even if the technical chart on the Australian dollar to US dollar looks bullish, the risk-off sentiment will crush it. The Aussie dollar will be sold, and the US dollar will be bought. If you try to buy the AUD because the RSI is oversold during a risk-off event, you are trying to catch a falling knife. You are fighting the entire global flow of fear. This brings us to the concept of correlation. Currencies do not move in isolation. They are interconnected webs of value. Consider the Canadian dollar, CAD. Canada's economy is heavily reliant on oil exports. Therefore, the CAD has a massive positive correlation with the price of crude oil. If oil prices are surging, the CAD usually strengthens. If you are trading the US dollar to Canadian dollar pair, you are essentially trading oil. If oil goes up, US dollar to Canadian dollar goes down because the CAD gets stronger. A professional trader checks the chart of Brent crude or WTI oil before placing a trade on the CAD. If oil is hitting a major resistance level and looks ready to drop, buying the CAD is a low probability play. Similarly, the Australian dollar AUD has a historical correlation with gold. When gold prices rise, the Aussie often follows. By understanding these invisible links, you can avoid overexposure. Imagine you buy the euro to US dollar and you also buy the pound sterling to US dollar. You might think you have two different trades. You don't. Both the euro and the British pound are European currencies that generally move against the US dollar. If the dollar gets strong, both of your trades lose. You have effectively doubled your risk on the US dollar without realizing it. A professional builds a portfolio of non-correlated assets. They might have one trade short on the US dollar to Japanese yen and another long on the euro to Australian dollar. These trades are driven by different factors, providing true diversification. The final pillar of fundamental analysis is the central bank narrative. You don't need to read every meeting minute, but you must know the stance of the Big Four: the Federal Reserve (USD), the European Central Bank (Euro), the Bank of England (GBP), and the Bank of Japan (JPY). Trading is essentially a game of pairing a strong currency against a weak currency. We call this strong/weak analysis. Imagine the Federal Reserve is aggressively raising interest rates to fight inflation. This makes the USD strong. Simultaneously, imagine the Bank of Japan is keeping interest rates negative to stimulate growth. This makes the JPY weak. This creates a fundamental divergence. The policies are moving in opposite directions. This is the holy grail of swing trading. You look for technical setups to buy the US dollar to Japanese yen. You are buying the strong currency and selling the weak one. These trends can last for months or even years. Technical analysis tells you when to enter, the specific entry price. But fundamental analysis tells you what to trade and which direction to trade it. However, there is a catch. The market is a discounting mechanism. It looks forward, not backward. By the time the news is on CNBC, it is often too late. The phrase "buy the rumor, sell the news" exists for a reason. Case studies suggest that often, when good news is finally released, the currency drops. Why? Because the smart money bought weeks ago in anticipation of the news. When the news comes out, they use the liquidity provided by retail traders, who are buying the headline, to sell their positions and take profit. This is the bull trap. So we have built a complete trader. You have the strategies, part 2, 3, 4. You have the risk management, part 5. You have the technical confluence, part 6. And now you have the fundamental context, part 7. You have a perfect car, a perfect map, and you know the weather forecast. But there is one variable we haven't accounted for: the driver. You can have the best plan in the world, but what happens when your heart starts racing? What happens when you lose 3 trades in a row and the little voice in your head says, "Just bet double on the next one to win it back"? What happens when you are up $5,000 and you get greedy, refusing to take profit because you want $10,000, only to watch the market turn around and leave you with nothing? This is the inner game. It is the graveyard where 90% of traders are buried. It is not the market that beats you. It is your own biology. In the next part, we are going to dissect the neuroscience of trading. We will explain why your brain is biologically wired to fail at trading, and how you can hack your own psychology to override millions of years of evolutionary instinct. We are going to talk about the cycle of doom. The cycle of doom begins with a biological glitch. Your brain is an evolutionary marvel designed over millions of years to keep you alive on the savannah. It is optimized for one specific function: survival. It is expert at detecting immediate physical threats: a rustle in the bushes, a predator's shadow, or the smell of smoke. When the brain detects a threat, the amygdala, an almond-shaped cluster of nuclei deep in the temporal lobes, initiates the fight or flight response. It floods your system with cortisol and adrenaline. Your heart rate spikes, your pupils dilate, and crucially, blood is diverted away from your prefrontal cortex, the logic center, and sent to your muscles so you can run or fight. Here is the tragedy of the modern trader. Your brain cannot distinguish between a saber-toothed tiger and a red candle on a chart. To your amygdala, losing money is perceived as a physical threat to your survival. Money represents food, shelter, and status. When you see a trade go against you, your biology hijacks your logic. You literally become dumber in real time. You lose the ability to think probabilistically, and you revert to instinct. This is why you make decisions in the heat of the moment that seem insane when you review them calmly on the weekend. You are not fighting the market. You are fighting your own DNA. Let's walk through the cycle of doom step by step. This is a pattern repeated by millions of traders every day. It starts with phase 1, euphoria and greed. You see a setup, It looks perfect. You enter the trade. Immediately, your brain releases dopamine. You are not just seeing a chart. You are visualizing the result. You imagine the profit. You mentally spend the money. You think, this is the one. You are already counting your chickens before they hatch. This optimism bias blinds you to the risks. You might even ignore your position sizing rules because you are so confident. Then comes phase 2, the turn. The market ticks against you. It drops 10 pips. You are slightly in the red. The dopamine cuts off. A tiny drop of cortisol enters the bloodstream. You think, it's okay, it's just a pullback. The structure is still good. This is rationalization. You are now married to the trade because your ego is involved. You don't want to be wrong. Phase 3 is denial and bargaining. The price drops further. It is now approaching your stop loss. This is the critical moment. Logic dictates you should accept the small loss and move on. But the survival instinct screams, if I close this now, the loss becomes real. To avoid the pain of realizing the loss, you do the single most destructive thing a trader can do. You move your stop loss. You widen it. You tell yourself, I just need to give it a little more room to breathe. It will come back. You are bargaining with the market. You have abandoned your strategy and entered the realm of hope. Phase 4 is panic and capitulation. The market continues to drop. The loss is now 3 times larger than your original risk. Your heart is pounding. You are sweating. You are staring at the screen paralyzed. The pain of the loss becomes unbearable. It hurts physically. Finally, the pain exceeds your threshold. You scream internally, just make it stop. You click close position. You realize a massive loss wiping out weeks of progress. Phase 5 is despair and the twist. The moment, the literal second you close your trade, the market reverses. It shoots back up in the original direction you predicted. If you had just held on, or if you hadn't moved your stop initially, you would be fine. This is the ultimate psychological torture. You feel like the market is personally targeting you. You feel stupid. You feel cheated. Phase 6 is revenge. Anger takes over. You want that money back now. You see a green candle and you click buy with double the lot size, ignoring all your rules. You are now gambling. This usually leads to a second larger loss, completing the cycle of doom and blowing up the account. This cycle is driven by a concept discovered by Nobel Prize-winning psychologists Daniel Kahneman and Amos Tversky called prospect theory, or loss aversion. Their research proved that the pain of losing $1,000 is psychologically twice as powerful as the pleasure of gaining $1,000. We are not rational utility maximizers. We are emotional pain avoiders. This explains the retail paradox. Beginners hold losing trades for too long, hoping to avoid the pain of the loss, and cut winning trades too early, fearing the profit will disappear. This is the exact opposite of the profitable formula. Cut losses short, let winners run. Your biology urges you to cut winners short, let losers run. You have to rewire your brain to do the unnatural thing. So, how do we hack this system? How do we override millions of years of evolution? You cannot willpower your way through this. You need external disruptors. First, you must embrace acceptance of risk. Most traders place a trade, but they haven't truly accepted the risk. They accept the possibility of a loss, but they expect a win. Mark Douglas, the author of Trading in the Zone, argues that you must genuinely surrender to the uncertainty. Before you click buy, you must look at the dollar amount of your potential loss and say, I am willing to spend this money to find out if the market will pay me. You must view the loss not as a failure, but as a business expense. If you run a restaurant, you don't cry when you buy tomatoes. It's a cost of doing business. A losing trade is simply the cost of the tomatoes. Second, you must implement mechanical interrupters. If you suffer from the urge to move your stop loss, you must use a platform setting that hard locks your stop. Some brokers allow you to set a rule where you cannot move a stop loss further away once it is placed. If you suffer from revenge trading, you need a circuit breaker. This is a rule, often enforced by a trading partner or automated software, that locks you out of your account for 24 hours if you hit a certain loss limit, e.g., down 3% in a day. You physically remove the ability to do damage while your prefrontal cortex is offline. Third, you must switch from outcome-based thinking to process-based thinking. Amateur traders judge a trade by whether it made money. Professional traders judge a trade by whether they followed their plan. Imagine a scenario where you break all your rules, take a massive risk, and make $5,000. To a professional, this is a bad trade. Why? Because it reinforced bad habits. You were rewarded for reckless behavior. Eventually, that behavior will kill you. Now imagine you follow every rule perfectly, you wait for the setup, you manage your risk, and you lose $100. To a professional, this is a good trade. You executed the process flawlessly. The outcome was just a statistical variance. If you repeat that good process 100 times, the edge will play out. You must keep a psychology journal. Next to your technical notes, you must write down your emotional state. Enter trade feeling anxious. Exited early because I was scared. Over time, you will see patterns. You will realize, I always lose money when I trade after an argument with my spouse. Or, I always over-leverage on Fridays. Self-awareness is the first step to disinfection. We have now stripped down the market, the math, and your mind. You understand the strategies, scalping, day swing. You understand the armor, risk management. You understand the enemy, yourself. But knowledge without execution is hallucination. You can read every book on aerobics, but until you get on the treadmill, you are not getting fit. You need to take all these abstract concepts and condense them into a single physical document that sits on your desk. A document that acts as your boss, your risk manager, and your legal code. This document is called the trading plan. It is not a vague idea. It is a rigid contract you sign with yourself. In the next part, we are going to build this plan together section by section. We will define your daily routine checklist, your if-then syntax for entries, and the specific criteria that define when you are allowed to turn the computer on, and more importantly, when you must turn it off. We are going to professionalize your passion. This is where the rubber meets the road. We are going to take the chaos of the global financial markets and compress it into a single static document. This document, your trading plan, is the only boss you will ever have. It is the CEO of your trading business, and you are merely the employee responsible for executing its orders. If you cannot follow the instructions written in this plan, you should fire yourself. A professional trading plan is not a wish list. It is a standard operating procedure similar to what a surgeon uses before an operation or a pilot uses before takeoff. It removes the question, "What should I do?" and replaces it with, "What does the plan say?" Section 1 of your plan is the pre-flight checklist. You do not simply wake up, roll out of bed, turn on the computer, and buy the euro because it looks low. That is negligence. Your checklist begins with a biological audit. Are you tired? Are you hungover? Are you emotionally distressed from a personal argument? If the answer is yes, the plan dictates that you do not trade. You are compromised. Next, the checklist moves to the environment. You check the economic calendar for red folder events. If the Federal Reserve Chairman is speaking at 10 a.m., your plan might state, "No new entries between 9:30 a.m. and 10:30 a.m." This simple rule saves you from the algorithmic whipsaws we discussed earlier. You then check the correlated assets. You look at the dollar index, DXY, gold, and oil. If the DXY is ripping higher, your plan forbids you from buying the euro to US dollar regardless of the pattern because the macro pressure is against you. Only when all these boxes are ticked are you allowed to even look for a trade setup. Section 2 is the strategy syntax. This is the core of your document. It must be written in strict if-then logic. Ambiguity is the enemy of execution. You cannot write, "I will buy when the market looks bullish." That means nothing. It relies on your feeling, which we have established is unreliable. Instead, you write, "If price is above the 200-period simple moving average on the 1-hour chart, trend condition, and price retraces to touch the 20-period exponential moving average, value condition, and a bullish pin bar candle closes, trigger condition, then I will place a buy stop order 2 pips above the high of the pin bar." Notice the precision. There is no room for interpretation. You are programming yourself to act like a computer. If the pin bar does not close, you do not enter. If the price touches the 20 EMA but smashes through it without stopping, you do not enter. You are waiting for a very specific picture. This protects you from boredom trading. If the market does not present the specific picture defined in your plan, you are not trading. You are simply observing. This redefines your job description. You are not paid to trade. You are paid to wait for the setup. Section 3 is the risk management protocol. We discussed the math in part 5, but here is where you codify it. You write down your hard limits. Max risk per trade, 1% of account balance. Max open positions, 2. Max daily drawdown, 3%. This last rule is your circuit breaker. If you lose 3 trades in a row and hit a 3% loss for the day, the plan commands you to shut down the terminal. You are done. You live to fight another day. This prevents the catastrophic tilt, where a bad morning turns into a blown account by lunchtime. This section also defines your exit management. Do you move your stop loss to break even after the price moves 1R in your favor? Do you take partial profits at 2R? Write it down. Do not decide in the middle of the trade when your heart is racing. Decide now while you are calm and stick to the script. Section 4 is the post-market review. Your work is not done when the market closes. You must grade your performance. But here is the shift. You do not grade yourself on how much money you made. You grade yourself on how well you followed the plan. Create a scorecard. Did you wait for the candle close? Yes or no? Did you calculate your position size correctly? Yes or no? Did you exit according to your rules? Yes or no? Imagine a scenario where you lost $200 today. You open your journal. You see that you followed every single rule in your plan. The market simply didn't go your way. You grade that day an A. You should feel proud. Now imagine you made $500 but you realize you took a trade before the news release, ignored your stop loss and got lucky. You grade that day an F. You should feel ashamed. You reinforce bad habits that will eventually destroy you. This mental shift from profit-centric to process-centric is the hallmark of a professional. You need to physically print this plan. Do not leave it as a digital file buried in a folder on your desktop. Print it out. Sign it at the bottom like a contract. Laminate it if you have to. Tape it to the wall behind your monitor or place it on your desk. When you feel the urge to do something stupid like doubling down on a loser, you look at the document. You read the rule that says, "No martingale." It acts as an external superego, a voice of reason that overrides your internal panic. Let's look at a case study of two traders, Sarah and Mike. Both see the pound sterling to US dollar falling. It hits a support level. Mike has no written plan. He thinks, it's gone down a lot, it has to bounce. He buys. The price drops further. He panics. He thinks, maybe I should hedge it? He sells a second position. Now he is long and short at the same time, bleeding spread fees, completely confused. He closes both for a massive loss, stressed and angry. Sarah has her plan taped to her monitor. She sees the price hit support. She looks at her if-then syntax. If price hits support and prints a bullish engulfing candle, then buy. She watches the chart. The price hits support, but it prints a big red bearish candle. It does not print an engulfing candle. Her condition is not met. She does nothing. She sips her coffee. The price smashes through support and keeps falling. Sarah lost nothing. She preserved her capital because her plan protected her from a low probability entry. Mike lost 5% of his account. Sarah lost 0. Sarah is the better trader, not because she won, but because she didn't play a bad hand. However, having the perfect plan and the perfect mindset is useless if the infrastructure you are building on is corrupt. The Forex industry is notoriously opaque. It is filled with B-book brokers who profit when you lose, offshore entities with no regulation, and educators selling $5,000 courses that teach you basic support and resistance. You are swimming in shark-infested waters, and the sharks aren't just the institutional banks. They are the very platforms you trust with your deposit. How do you know if your broker is actually placing your trades in the real market, or if they are just betting against you in a digital simulation? How do you distinguish between a regulated, segregated account and a bucket shop that will disappear with your money next week? And what about the prop firms offering you $100,000 of capital to trade? Are they legitimate opportunities or sophisticated Ponzi schemes designed to harvest your evaluation fees? In the final part of this masterclass, we are going to perform a forensic audit of the industry infrastructure. We will give you the checklist for vetting a broker, explaining the critical difference between A-book and B-book execution. We will discuss the specific software tools you need, from charting platforms to journaling software, to run your business professionally. And we will issue a final stern warning about the scams that target beginners, ensuring that when you finally deposit your hard-earned capital, it is safe. This is the final barrier to entry. You are standing at the gates of the financial world, checkbook in hand, ready to fund your account. But before you wire your hard-earned savings, you must understand the invisible war being fought behind the sleek trading platforms and helpful customer service chats. The financial industry is divided into two distinct camps, the A-book and the B-book. Understanding the difference is not just technical trivia. It is a matter of financial survival. Imagine you walk into a casino. You play roulette. If you win, the casino loses money. If you lose, the casino keeps your chips. The casino is betting directly against you. This is exactly how a B-book broker, also known as a market maker, operates. When you place a buy order for the euro to US dollar, they do not send that order to the real market. They keep it in-house. They take the other side of your trade. Therefore, a B-book broker has a direct financial incentive for you to lose. If you are a profitable trader, you are a liability to their business model. Historically, unethical B-book brokers have been known to engage in stop hunting, artificially widening spreads or creating phantom price spikes on their platform to trigger your stop loss and pocket your equity. Contrast this with an A-book or ECN/STP broker. When you place a trade with them, they instantly pass your order to a liquidity provider, a massive bank like JP Morgan, Deutsche Bank, or UBS. The broker does not care if you win or lose. They make their money by charging you a small commission on every trade regardless of the outcome. In fact, an A-book broker wants you to be profitable because the longer you survive and the more you trade, the more commission they earn. Their interests are aligned with yours. When vetting a broker, you must explicitly check their execution model. If they offer zero spreads and zero commissions, but are unregulated in a major jurisdiction, you are almost certainly walking into a B-book casino that is rigged against you. This leads us to the bedrock of safety, regulation. In the world of Forex, geography is destiny. You should only ever deposit capital with brokers regulated by Tier 1 authorities. These are the NFA in the United States, the FCA in the United Kingdom, and ASIC in Australia. These regulators enforce strict capital requirements and segregation of funds. Segregated funds means your money is kept in a completely separate bank account from the broker's operating capital. If the broker goes bankrupt tomorrow, your money is safe and cannot be used to pay their debts. If you see a broker licensed on a tiny island nation you have never heard of, offering 1,000 to 1 leverage, run the other way. In those jurisdictions, your legal recourse is zero. Your money is effectively a donation. However, the landscape of retail trading has shifted dramatically in the last 5 years with the rise of proprietary trading firms, or prop firms. This model offers a seductive proposition. Trade our capital, keep 80% of the profit. You pay a small evaluation fee, pass a challenge to prove you can trade, and they give you access to a funded account worth $50,000, $100,000, or even $200,000. This solves the biggest hurdle for beginners: undercapitalization. It is impossible to make a living trading a $500 account with proper risk management. But with a $100,000 account, a 3% monthly return is $3,000, a viable income. But be warned. Case studies suggest that the majority of prop firms rely on the failure of their applicants. They profit from the evaluation fees of the 90% who fail. Only the top tier of legitimate firms actually pay out consistently. Treat these firms as a tool to scale, not a savings account. Read the fine print regarding drawdown rules carefully, as they are often designed to trip you up. Once your infrastructure is secure, you need the weapons of war. You cannot trade professionally using a smartphone app. You need a robust charting platform like TradingView to perform the multi-time frame analysis we discussed in Part 3. You need backtesting software to replay historical data. You must simulate your strategy over the last 2 years of market data before you risk a single dollar of real money. If your strategy didn't work in 2023, it won't work in 2025. Backtesting builds the statistical confidence required to hold trades during the inevitable losing streaks. Furthermore, you must inoculate yourself against the guru industry. The internet is flooded with advertisements showing young men in rented Lamborghinis promising 99% win rate signals, or automated trading bots that print money while you sleep. Let's apply basic logic. If someone had a software bot that could guarantee a 10% monthly return with zero effort, they would possess the most valuable algorithm on earth. They would not sell it to you for $49 a month. They would run it quietly in a dark room and become a billionaire. Signal services, where you pay to copy someone else's trades, are equally dangerous. Even if the trader is legitimate, execution latency will kill you. By the time you receive the notification, unlock your phone, and place the trade, the price has moved. They entered at a better price. You enter late. They make a profit, you take a loss. You cannot outsource your judgment. If you do not understand why you are entering a trade, you are not a trader. You are cargo. We have now reached the end of this masterclass. We have traveled from the chaotic liquidity of scalping to the strategic patience of swing trading. We have built an unbreakable risk model that renders bankruptcy mathematically impossible. We have dissected the neuroscience of fear and greed, and we have constructed a rigid trading plan to govern your behavior. You now possess the theoretical framework of the top 1% of retail traders. But theory is safe, practice is messy. The market is the ultimate mirror. It reflects your character flaws back at you with brutal honesty. If you are arrogant, the market will humble you. If you are impatient, the market will rob you. If you are undisciplined, the market will destroy you. Success in Forex is not about finding a secret pattern. It is about the relentless mastery of oneself. It is about showing up every single day, filling out your journal, refining your edge, and accepting that losses are the tuition you pay for a life of financial independence. It is a journey of 10,000 small decisions. Most people watching this will do nothing. They will close this video, watch a cat video, and forget everything they just learned. They will remain in the 90%. But a small handful of you, perhaps the person listening to these words right now, will take this script, print the plan, open the demo account, and start the work. You will suffer through the learning curve. You will endure the drawdown. And 5 years from now, you will look back at this moment as the turning point where you stopped gambling and started building an empire. The charts are waiting. The market is open. The rest is up to you. If you are ready to take the next step and see these strategies applied in a live, moving market environment, where we face the pressure of real capital in real time, make sure you are subscribed. In our next series, we are going live at the open, applying the breakout and retest strategy to the New York session. Now go get to work.